I'm revealing my 3 favorite monthly dividend stocks as well as what to look for and the risks in dividend investing. By the end of this video, you'll not only have 3 stocks to start your dividend portfolio, but also how to value 3 special types of dividend companies. We're talking the best monthly dividend stocks today on Let's Talk Money. Beat debt, make money, make your money work, creating the financial future you deserve. Let's Talk Money. Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now, I love dividend stocks, but most only pay out 4 times a year. That can make it really difficult to plan for paying those expenses or as a passive income stream. That's where monthly dividend stocks come in. Companies with a policy and a history of returning cash to investors every single month. Even better, these stocks have a median yield over 8% annually. That's about 4 times the dividend yield on the broader market. These are some great opportunities to create that monthly cash flow that's either going to grow your portfolio or give you that extra cash each month to pay your bills. Now, I do want to warn you, these monthly payers tend to be in just a few business types. We see here that about 40% of monthly payers are in real estate investment trusts or REITs. Another 38% are in business development companies, and then some energy companies, usually master limited partnerships. There's a reason for this, and we'll talk about it and why these cannot be your only investments in dividend stocks. Again, do not think that you can put together a portfolio of just these monthly dividend stocks because it's going to put all your money at risk. In this video, we'll look at how to find these monthly dividend stocks and how to get started investing. I'll reveal the process I use for picking stocks along with the warning signs. I'm then going to highlight my 3 favorite monthly dividend stocks and why I'm investing in each. So subscribers already know why I love dividend stocks. Those cash returns are always positive even when the market tanks, and dividends actually account for as much as 70% of the total return of stocks in some years. Now, you can create a nice monthly payment from those regular dividend stocks, the ones that pay out once a quarter, but the planning it takes to match those quarterly payments means you want some monthly payers to fill in the gaps. The downside is that you don't want all your portfolio in these monthly payers. Like we saw in that graphic, putting all your money here is going to grossly expose you to just a few business structures. These companies set up as BDCs, REITs, or MLPs get a special tax break, but have to pay out almost all their earnings as dividends. That means they tend to have volatile share prices, they have to raise money regularly through debt or equity, and they're highly exposed to rising interest rates. Now, these monthly payers also tend to be much smaller companies than other stocks. For example, of the 28 legitimate monthly payers I follow, the average size is just $723 million, with the largest only about a $20 billion company. That might not seem like much, but it's a minuscule next to a $1 trillion company like Amazon or Apple, and none of the S&P 500 companies pay monthly dividends. The fact that they're all smaller companies with less financial flexibility means you need to stay up on all the usual warning signs for dividend stocks. These include sales growth, debt leverage, and some other signs you need to watch for. Now, I published a video on the 3 warning signs for a dividend cut a few months ago that I highly recommend all dividend investors watch, and I'll link to that in the video description below. Another thing to understand about investing in these monthly dividend stocks is that you have to understand the business. You can't value them like other companies. For example, those real estate and energy companies take huge amounts of depreciation that makes the reported earnings completely useless, so you can't use that price to earnings ratio you use on other stocks. You also need to understand the management structure in those business development companies, the BDCs. Now, it's either going to be external or internal management that's running these companies, which is going to make a big difference on their compensation. External management is usually compensated by growth in the company's invested assets, so they want to make as many investments as possible, even if they're not necessarily great investments. On the other hand, internal management compensation is tied more directly with those investor returns. So we'll be looking at that closely when we're looking at these BDC companies. Because it is so important to understand these business models and what makes a solid competitive advantage at a company, it's usually better just to focus on individual stock investing on no more than a few industries or business models. Most investors don't know it, but this is actually the way Wall Street works and how most analysts invest their own money. They have deep knowledge and maybe even work experience within a specific industry. Those are the stocks they analyze and invest in. Then the rest of their money is usually in broader market funds. This is what Peter Lynch was actually talking about when he said, invest in what you know. Most people think it's merely a matter of buying and liking a product, but it actually means having that deeper knowledge into how the business works. Yeah, sorry, liking Campbell's chicken noodle soup just isn't a good enough reason to invest in the stock. So let's look briefly at those three business models: MLPs, BDCs, and REITs, including how to value these companies and what to watch for. Then I'll reveal my 3 favorite picks from the group to get your dividend portfolio started. Now, MLPs are companies set up to own energy assets, usually oil or natural gas pipelines and storage facilities. MLPs get a fee from energy companies for letting them use those pipelines and storage. This is one major benefit of MLP investing, in that profits don't necessarily depend on the price of oil. The stock price is going to bounce around a little bit if the price of oil jumps or crashes, but the company is still collecting on those fees on that volume of oil pumped through the pipelines. Compared to an oil company where sales are directly affected by the price of oil, MLPs are a little safer here because of those fees. Now, since MLPs pass their income and expenses on to investors through special reporting, the company doesn't pay any taxes. That's a very efficient way to hold these assets, and it's why many oil companies have sold off their pipelines into an MLP company. With MLPs, you don't get that double taxes problem you get with regular companies, where the company pays taxes on profits first, and then investors pay taxes again on any of their returns. Now, another benefit to MLP investing is that the cash return you receive isn't all taxed in that same year either. Some of those dividends count to lower your cost in the shares, so you don't actually pay taxes on those until you sell the stock. If you pass those stocks on through your heirs to an estate, taxes are never paid on that portion of the returns. Now, because they pass almost all their income on to investors, MLPs have some of the highest cash return of any types of stocks. The dividend on the Alerian MLP ETF, a fund that holds shares of MLPs, pays an 8.4% annual dividend yield. Now, there is one downside to MLP investing I want to point out before we get on to how to value these stocks and my 2 favorite MLP picks. MLP investors are going to get a K-1 form, a special tax form each year from the company that details their returns. Now, this means a little bit more work at tax time to report on that investment, but any online tax software is going to make it easy to file your taxes on these. Now on to how to value an MLP. Now remember, you can't use that price to earnings ratio here. These companies have a huge amount of depreciation that makes earnings misleading, but it doesn't affect actual cash flow. So what we're going to do instead is use what's called the price to distributable cash flow, or price to DCF. Now, finding this value for distributable cash flow, the amount of money the company has available to return to investors, is really important because it gives us an idea of that dividend sustainability. A company can't pay out more than it's available forever, so this is a good metric to make sure that that dividend isn't going to be cut anytime soon. Now, I'll show you how to calculate the DCF yourself, but all MLPs are going to calculate it for you in their reporting. I do it myself just because I like to double check the numbers coming out of the company and make sure that I'm comparing stocks with the same calculation. So here's the table, and again, don't get freaked out here on these numbers because this is always provided to you in the reporting. To find how much money the company has available to distribute, you take the cash flow from operations. Now, this is all going to be found on the statement of cash flows, and you remove any spending on capital and income from non-controlling interest. That gives you the sustainable DCF, which is what the company can return to investors and still keep operations running smoothly. Now, while the sustainable DCF is a better measure, most people use the DCF as reported because sometimes it's the only number reported. To get to DCF, you also add back that income from non-controlling interest as well as working capital reported. The big one here is to adding back this proceeds from asset sales. Now, this is technically proceeds the company can return to investors, but a company can't be forever selling its assets and still keep in business, so that's why we use that sustainable DCF if it's available. With this number, you can find that valuation with the price to DCF, or you can find how much the company is returning to investors for what's called the distribution coverage ratio. This is how much DCF the company earns versus how much it pays out. Now, this last measure here is really important because an MLP that pays out more than its distributable cash flow just can't do so forever. You see here the coverage ratio for a group of MLPs, and that the average is around a DCF that's about 1.2 times the distribution. This means the company has cash flow about 20% higher than what it's returning, but you also see that some companies here that have saved back much more or less. Now on to real estate investment trusts, or REITs. Now, REITs are special companies set up to manage commercial real estate and pay out the cash flow to investors. REITs can specialize in a specific property type, so apartments, office, retail, warehouse, and self-storage, or they can hold a mix of properties. Most REITs hold properties across the country, so it's a great way to diversify your portfolio of individual properties, getting exposure to other regions and other property types. REITs pay no corporate taxes as long as they pay out at least 90% of their income to investors. So like those MLPs, this makes for a great way to manage property, avoid that double taxation, and also means huge cash dividends for investors. There are primarily two types of REITs, an equity REIT which actually owns the properties, and then a mortgage REIT which invests in real estate loans. Now these mortgage REITs pay higher dividends, but they also tend to be much more volatile, especially when interest rates are rising. I've invested in mortgage REITs but prefer equity REITs as a better long-term investment. Just like with those MLPs, you can't rely on reported earnings for a REIT because of that high amount of depreciation they get from real estate. Instead, we use a measure called the Funds from Operations, or FFO. Now FFO is very similar to that DCF measure we saw in MLPs. You take the reported net income of the REIT and then add back any depreciation but minus out any gains they made on property sales. Those property sales are a legitimate source of income, but that's not something the REIT can do forever and expect to stay in business. Investors also look at the adjusted funds from operations, this AFFO. This one takes into account capital expenditures, and CapEx here is what the company spends to keep its properties in good shape, so that maintenance spending. Remember, the idea is to find out how much cash the company has available to distribute without cutting into money it needs to run the business. Finally, business development companies are special financing companies that fill the gap for loans and small businesses. These companies set up a closed-end investment fund to make debt and equity financing to small and then medium-sized businesses. After the financial crisis, regulation like Dodd-Frank and Basel III made it harder for traditional banks to make loans to small businesses. Banks had to keep only higher quality assets on their balance sheet, which meant they couldn't make these riskier loans. So BDCs stepped up to fill that gap and provide huge dividend yields in the process. Now, the most important thing to consider when looking at these BDCs is that management structure. Most of these are externally managed, which means management doesn't actually work directly for the company. Compensation for these is usually based on a base fee plus performance of the net asset value. This means a higher cost structure and management rewards that aren't necessarily aligned with shareholder returns. Besides those higher costs, external management isn't required to disclose its compensation, which can mean conflicts of interest. These managers have to reach for riskier loans and investments to justify their higher costs, so that can mean a lot more risk for investors. This is why I generally only invest in BDCs with internal management, so I can see exactly what management is earning and how it's compensated. Now, looking at BDCs, you also want to look at the portfolio yield in the financial statements. This is the average rate earned by the company on its different loans, and there's two things you want to look at on this. First, it's a good sign when the company's portfolio yield is at or below industry average. That might seem counterintuitive, looking for a lower than average yield, but that lower yield usually means less risks in loans and a more conservative management. You also want to check the portfolio yield against the dividend yield on the stock. Now, portfolio yield above the dividend means that management can easily support that payout and the dividend isn't in danger of being cut. Besides that portfolio yield with BDCs, you also want to look at the company's net asset value, or NAV. Now, BDCs issue new shares frequently to raise money for growth, so even if the NAV is growing, you want to make sure that the NAV per share is growing. That means you're not getting diluted by new shares being issued. An NAV per share might not grow much faster than low or mid-single digits a year, but just consistent positive growth is what you're looking for. So I know this has been a lot to look at, but these are very different types of companies with their own advantages and risks. I'm going to reveal my favorite monthly dividend stocks next, but I want you to be ready to look at these stocks yourself and understand exactly what you're getting into. Our first monthly stock here is Gladstone Commercial, or ticker GOOD. It's a diversified real estate investment trust with industrial and office property across the United States. Now, Gladstone operates in the net leased market for its properties, meaning tenants pay almost all the costs. Now, this means rates are lower, but also much lower risk and operating costs for the company. Occupancy on 99 properties in 24 states is 97.9%. That's excellent for a real estate portfolio. The fact that it's almost 100% leased speaks to the quality of property and management. Average lease terms remaining on the properties is about 7.5 years, with average terms on mortgage debt of about 6.5 years. Now, Gladstone pays out an 8% annual dividend on a monthly basis and has returned over 9.2% a year over the last 5 years. The company has produced a fairly consistent funds from operations of $1.54 per share, which is just slightly over the annual dividend paid. Now, our next dividend stock is Sabine Royalty Trust, ticker SBR. It's an energy trust established in 1982 on landowners' royalties and other energy assets. The company has an oil and gas portfolio that covers over 2 million acres in Florida, Louisiana, Mississippi, New Mexico, Oklahoma, and Texas. Reserves on the assets are estimated to produce at least another 8 to 10 years, and the parent company regularly explores for new assets. Now, the trust grew distributable income by more than 28% to $2.32 per share in the first 9 months of 2018 versus that same period in the previous year. It pays out nearly all of that in distribution, so I'd like to see a little bit more leeway, but that's an amazing increase, and shares pay a solid 8.4% dividend. Now, our third dividend stock here is Main Street Capital, ticker MAIN. It's a business development company specializing in long-term debt and equity investments. Main Street reports one of the lowest management fees as a percentage of its portfolio in the industry, and it's internally managed, which is great. The company is one of the few legacy BDC companies from before the financial crisis. Now, I like that because it means management understands the loan cycle and how a recession is going to affect the business. Main Street's portfolio yield is around 11%, which is under the industry average of 14% and well above the dividend. The shares pay a marginally lower dividend yield at 6.2%, but the price appreciation has produced a 10.3% annualized return over the last 5 years. Now, I'd love to hear about your favorite monthly dividend stocks and what you look for in dividends. Be sure to scroll down and tell us in the comments how you invest in dividends. We're here Mondays, Wednesdays, and Fridays with the best videos on beating debt, making more money, and making your money work for you. If you've got a question about money or investing, just subscribe to the channel and ask it in the comments. We'll make sure you get an answer in a future video.